There's quite a buzz around the recent drops in rates. Here's how it's affecting the real estate investing industry.
Hey, buddy.
Hey.
Did you hear about interest rates?
Oh, yeah, I did.
It's bananas, isn't it?
I laughed when we got some of the announcements coming through. This is we're probably 10 days now from that initial rate drop. And I was talking to one of our sales members, Nicole, and I was like, get a diaper. Get some coffee, sit down, prepare yourself.
Get a diaper.
Because, I think when these rate drops happen, everyone kind of gets excited and wants to talk and figure out where things are going and whatnot. And so we thought it was really good for us to jump on here and at least maybe explain why there was a rate drop.
Sure.
Because I think that some people will care about that.
Yeah.
But I also think it explains a little bit more as to, are we going to see further ones? What the rest of the year looks like and where we're going in regards to interest rates. So, do you want to give the backstory on why we actually saw the interest rate drop?
Sure. Yeah. So we're going to the far off land of Japan. Mm-hmm. So the Bank of Japan has kept interest rates at zero in their country for about 17 years. The reason why they did that was to increase economic activity, decrease the risks of deflation, and this year they have decided to change that policy and increase rates. They increased rates by about a quarter point, which was a big deal. Why was it a big deal? It was a big deal because up to this point, it was a very common trade to borrow Japanese yen at 0% or next to 0% interest rates, and then turn those into U.S. dollars, and then buy stuff, buy equities and bonds and all kinds of different things. When Bank of Japan increased that quarter point, all of a sudden it put some of those trades upside down, which caused all those traders to sell off those assets, turn their dollars back into Japanese yen, and then pay off those loans. So when you have that kind of major shift, a common thing that will happen is a rate decrease. And so overall, I would say we saw about a point decrease on DSCR loans overnight.
Overnight.
It went from 8.3 to 7.3 very quickly.
Very, very quickly.
Yeah.
So most of your eyes just glazed over as Adam is talking about all this economics shenanigans. But in short, what we want you guys to know is that rates are lower right now. Now, is this going to be forever? God only knows. I ordered my crystal ball from Amazon and haven't received it, so I'm a little ticked, but 2 days
Jeff.
shipping.
Come on, Jeff. I know you listen and you subscribe to the Loan Lounge. Where's your crystal ball?
But I think I always like to speak in facts. So we always get those clients that are like, hey, should I do it right now or are rates going to drop further? I speak in facts. What I can tell you is right now, this is what we can offer. And so, yes, rates are, I would say purchase rates are in like the mid sixes. Cash out refi rates are definitely in the high sixes. This is an opportunity for people to take a look at their portfolio and see what makes sense. The feds are expected to meet 2 more times this year. They've said they were going to drop rates, through this year completely and haven't yet. So maybe we'll see some further drops in that regard. I don't know that that'll directly correlate to us because a lot of our DSCR lenders are actually funded by hedge funds. And so they don't really change interest rates like conventional does, where I would say on a daily basis, rates drop, change slightly every day on the conventional side. We typically get a rate, new rate sheets, et cetera, like once a month, every couple months. So our lenders just don't change dramatically. I will say right now though, so I'm going to say that comment and then I'm literally going to take that back. With these changes, we've had a couple lenders that are now basing rates off of the 5-year treasury.
Yep.
Which is something that you guys can Google.
Yeah.
Google the 5-year treasury. If you see the 5-year treasury drop exponentially, it may turn into our rates dropping exponentially as well. So if you guys go back in time about 10 days ago, you will see where that plummeted nearly a full percent, and that's where a lot of this change happened. But with that being the case, and that 5-year treasury going up and down like this every day, that does change our rates slightly. And a lot of these lenders also are not locking rates because of the ever changing and the volatility. And so, we have one lender that will lock at application, but it depends kind of how the deal's structured. If the property's leased or not, on a purchase, it wouldn't matter. So that one's solid. Then we have two other lenders. One will not lock till final approval, so they're just going to have you hang out and float along until you're there. And the third one is locking once appraisal comes in. So, and we try to let our borrowers know very much upfront as to where they are. So if you are someone that wants to like keep your eye on the 5-year treasury and kind of be mindful of that, great, awesome. I don't recommend it. It's not going to change probably super significantly. Not enough that I would say in a lot of cases a deal would go from being alive to dead, unless another crazy thing happens. Like
I would say also something to keep in mind is as we talk about rates in the high sixes in some cases, that's for a particular deal. Like there's going to be some minimums there that you're going to want to hit on loan amount in order for that to make sense, because some of those lenders are going to require minimum origination charges, and as a percentage of the loan amount, sometimes that can be higher than what you might be used to if you want to get that rate. And if you're with a real small loan amount, like $100,000 or something, the difference between 6.875 and 7.125 is negligible.
Yeah,
it's like $20. Yeah, $15 a month, $20 a month, something like that. So, if that, like I always say, is don't get the rate. Kind of doesn't matter. Like, don't get married to the rate. Let's take a look at the overall picture. Give us a call, and we can help you navigate that.
Yeah, I would say people are making decisions now on like, oh, I've been like holding off refining because I don't really need the cash out of this property.
Yeah.
If I had it, could I do something with it? Sure. But like, let's make this make sense. Like, make it look sexy for me before I do it. This may be the sexy time to consider doing those type of activities. But I don't think, and I do believe that there have been deals that, purchase deals where that deal didn't cash flow enough before. You drop the rate by a full %. Those deals are now starting to make sense, which I think opens up the market considerably. I think the interest rates that people are basing their numbers off of need to slightly change. Do 7.25, like cover yourself a little bit for some cushion, because you may, depending on credit, depending on loan size, it may change slightly. But this is a new opportunity. This is just a nice point to reset and say, great, what am I basing my numbers off now? Am I doing my calculations correctly? Because previously, if you would have been going off of 8%, that deal potentially didn't work, where now it does.
Yeah.
One thing that I was super intrigued by, and we're still in this moment where, so at any given time, LFG is working with about 40 to 50 different lenders. I would say actively working. We're probably actively working with about 18.
Yeah.
And out of those 18, I would say more than 50% of them have yet to do a change in interest rate at all.
Yeah.
And I don't have the secret sauce. I don't know why. I'm not sure if they were like waiting for the other shoe to drop or waiting for things to kind of stabilize before they make changes. We had another, I would say 30% of them that made some change, but not the major full 1%. And then we really have like 5 lenders right now that went nosedive and are just very aggressively trying to get business. And the reason I bring this up is, depending on who you're currently working with, you may be part of the 50% that haven't made a change. And if you're not working with a mortgage broker where we can be shopping constantly for you, then you're not going to know of some of these people that are making changes and where these opportunities really are.
Another thought that I have is, okay, let's say we're talking about cash out refis. What are you going to use that cash for? I have a couple clients that are constantly waiting for 2.75% to come back around again. And it's not, not anytime soon. I think that, and then the next thing out of their mouth is, oh man, it's so hard. I've missed out on so many deals because I didn't have the cash free to take advantage of those.
Yep.
So what are they doing? They're getting married to that rate. They're so in love with the notion of a rate, which is a percentage, which isn't even actual dollars. It's just a way to calculate like how much you're going to be paying each month. And and they're missing out on other opportunities. So yeah, okay, well, if I take money out now, that'd be, $50 more a month than if I waited until it dropped another point. Okay, cool. Yeah, that $50, that's real important. But then I'm also losing out on this property that I could buy that I'm walking into $50,000 worth of equity. So you're tripping over dollars to save dimes, and it's just the worst possible thing that you can do.
Clap.
Yeah.
Preach.
Yeah.
I have this conversation all the time, and it drives me bonkers. And sometimes I just think they need the numbers.
Yeah.
And I don't know that they're doing the numbers. And so to a certain extent, please come to us. Let us do the numbers for you so that you can see, because, are we talking $50 or are we talking $500?
Yeah.
And to a certain extent, both of those still could be workable, but I think people need to understand what is the difference and how are you potentially limiting your potential of your real estate growth. And the sooner you get in these properties, the better. That long-term play, like I someone posted recently about, I'm not buying real estate for today, I'm buying it for the future. And that is 100% true. So that if you buy this today and when you retire, this thing's paid off and you have that cash flow, those are the plays that you're making. So if you can't get into it early enough, you're going to have these notes still outstanding as you're sitting at retirement, or maybe you're already at that point. So it's just looking at the facts.
Yeah.
And for everybody, it's different. We talk about this all the time of like the decision is made by you as a consumer, not by us. But let us give you those facts. And I definitely think with the rates decreasing, it's time to look at your portfolio, make sure you're in the right position, and then figure out, is your portfolio matching what your overall goals are for the next 5 to 10 years? Because we could be doing something now to ensure you hit those goals.
Yep.